Thanks for pressing play. You're listening to the Broady Windsor Group on Real Estate, the podcast for homeowners seeking guidance and support on everything related to owning a home. This includes much more than just buying or selling. We've got you covered for everything from mortgages and financing to home maintenance tips, renovation and design advice, and of course, the latest insights and analysis on what's happening in our local communities. Welcome to today's episode. I'm very happy to have our good friend Joe Valenti from Better-Mortgage.ca with us today.
Thank you, Scott. I'm delighted to be here.
It's great to have you, and I know we've been meaning to do this for quite some time, and we've got a lot to talk about today. And so I'm excited to jump into it. There's been a lot of talk in the media and the news about different government policies around first-time home buyers and mortgages. So I'm excited to have this conversation with you today.
As am I. Let's jump into it.
Awesome. So I think I'd like to start at a higher level overview and just get your explanation on what is the difference between an insured mortgage, an insurable mortgage, and a conventional mortgage. Because I've heard these terms, and even I wasn't sure exactly what the difference was.
They do lead to confusion. Ça porte à confusion, as we say in French. And I'll be happy to jump into that just as soon as I offer you a little bit of blatant flattery. I'm so happy to be here, Scott, and really flattered because I acknowledge the professionalism you guys put into these videos. I've watched them. They're top-notch. The work that you do with your clients, I've been really witness to the clients and the way that you handle them. The familiarity that you end up building, the rapport that you build with these clients is absolutely fantastic. They come to understand that your way of doing things just sets you apart from everybody else in the industry, locally or really anywhere else. And I'm really thrilled to be doing this with you today. It's just fantastic.
Well, let me tell you, I appreciate those kind words, Joe. Mm-hmm. But you may not know, Joe is a neighbor of ours. We share office space here, so it's always easy for us to pop in and
that's true.
Shoot the shit, if you will, about what's been going on. And so we appreciate the advice you've given us. Yeah. And actually, the impetus for today's episode as well was a video that you shared with me, giving an explanation of these new government policies around first-time home buyers. So I'm very much looking forward to it.
Oh, great. So now that we've complimented each other thoroughly,
let's go.
We can jump into it. The most basic transaction is a conventional mortgage where there's no insurance present. And by definition, a conventional mortgage is going to be one in which the purchase price of the home is above the threshold for insurance. And currently that's set at $1 million. Later on, we're going to talk about how that threshold is going to change. But we'll get to that later.
Yep.
For today, as we said at the beginning of October, that threshold is $1 million. So if you're purchasing a home for over $1 million, it's not insurable, and it's very normal, very boring. There's a lender, he lends you money, you pay him back. There's no insurance involved, and there can't be insurance involved. It's actually legislated that it's not even possible, and that has a cost associated to it. We'll talk about that. The second tier, in fact, we're going to go back to the bottom now, and that's the insured mortgage. So we got insurable in between, but the insured mortgage is one in which your down payment is, again, by definition, your down payment is below 20%. If it's insurable, by definition, it's on a property that's worth less than $1 million. So $999,999.99, and you're putting fewer than 20% down.
So the buyer is putting less than 20% down, therefore they have to take out what's called mortgage insurance.
And they're paying for it.
Which is usually CMHC or
one of their two competitors.
Exactly.
Got it. So, and there's a cost to that, and we'll talk about that in a minute too. But that's an insured mortgage, is one in which the borrower has paid a premium for the privilege of putting a lower down payment, protecting the lender to some extent. And if I may, I'll make a little segue to say this is the weirdness of insured mortgages. Imagine that you pay for life insurance on somebody else, and if you paid the money, but if they die, you don't get the money, somebody else does. Well, that's very much how mortgage insurance works. If you're the consumer paying the premium, you're paying CMHC, but if you don't pay your mortgage and the whole thing gets triggered, it's not you that benefits, it's the lender. The whole idea is to protect the lender from the risk of default.
And now an insurable mortgage, what's the definition of that?
There's one in between, and it's one in which there's the most confusion. So now, again, by definition, if it's insurable, it means that the value is below $1 million. But let's imagine that your down payment is above that 20%. So as a consumer, you're not required to pay it great. I don't have that expense. That's fantastic. What people don't know is that the lender can themselves go and say, well, if it's below $1 million, so what if his down payment's higher? There's a table that CMHC sells these premiums at. I'm going to step up and I'm going to buy the insurance, says the lender, to protect myself.
Okay.
Because now if that borrower were to forfeit, I have literally zero risk. I'm good and I'm done. It's worth it to me in a business to pay the premium and to now have a risk-free mortgage. And it turns out in many situations, not everyone, but in a lot of situations where the mortgage is insurable, the lender will choose to pay that premium themselves and you don't even know about it. And that's fine. So the curious thing when we get to the rates you'll see is that there's very little, in fact often zero difference between the rate the consumer pays between an insured mortgage, where they assume the cost of insurance,
right,
and the insurable mortgage, in which the consumer does not assume that cost, the lender does.
Okay, so the benefit to the homeowner is they're getting someone else to pay that insurance, therefore...
Excellent, Scott, t'as tout compris.
So they would actually benefit from a better rate because the lender would conceivably give a better rate to someone who's a lower risk.
That's exactly right.
Got it.
So, and the lender is, but even more than that, the lender is paying the premium to CMHC or their competitors. They literally have no risk. And so the bank's business model is very much, I'm going to borrow money from one place in the bond market and sell it to you at a different price. I make my money, I have no risk, I'm done.
Okay.
And that's the business model associated to everything that is assurable.
So this is why rates are typically lower for insured mortgages.
Absolutely. And it's all about the risk that's assumed by the lender.
Okay.
Now, the lenders have competitors, of course, and there's other things than just insurance that put downward pressure, as it were, on rates. They can't charge you an infinite amount because there's competition.
Right.
But no question that a big element of that is the fact that, hey, if there's lender is literally taking no risk on an insured or insurable mortgage, again, insurable, and they decide to pay the premium, but that's up to them, not up to the consumer. It's up to them.
Got it. So now let's just talk about the new policies that we've heard about very recently, that the government policies that are for first-time home buyers,
right?
And these are coming into effect when?
So just before we get into the first-time home buyer thing, let me just mention to you there's a separate piece of news, and it has directly to do with what we've just been talking about, and that is the change in the threshold. So that actually comes up first. It's the 15th of November of 2024, and on that date, the threshold for an insurable or insured mortgage goes from less than $1 million to less than 1.5 million. So 1.499999.99 and less means that mortgage is now insurable. Pretty much nothing else changes. There's a lot of things that could have changed. I was expecting they might change, but they didn't. And it's as simple as that. So the number is going from 1 million to 1.5 million.
So if I'm a home buyer and I'm in the market for a home that's up to that $1.5 million threshold now.
Just below,
and I'm putting down 20%.
Right.
That's an insurable mortgage now, meaning I could get a better rate than I could have before.
That's Joe. So you've really hit the nail on the head. That's the one big advantage, and especially in our market in the West Island, there's a good number of houses that are in that kind of sweet spot between $1 million and 1.5, and now the buyers of those homes are going to be able to qualify for the lower insured or insurable rates that apply to it.
And this is any homeowner.
Great. Yeah, any homeowner. That's why I wanted to talk about that before we get into the first time.
Right. And now the other one that's affecting first-time home buyers.
Before we get to that, let me just mention that there's always a caveat, and that is to say, just because you can do a thing doesn't mean you should. And let's just do the math, and I'll do this with our respective clients, is to say, it turns out that the minimum down payment you can make on your 1.5 or just less house turns out to be just around $300,000. If you do that math, if I'm putting $300,000 down, that's a lot of money, but I'm still borrowing $1.2 million for 25 or whatever number of years. That's a lot of interest, and maybe you want to make sure that you can look at that monthly payment on $1.2 million borrowed at whatever any percentage rate is going to be a lot of money. So people shouldn't get the impression that the change in the threshold is magically going to make the home more affordable. It doesn't. It's math. It makes it possible, not more affordable.
Gotcha.
Yeah.
Gotcha. So how would you advise clients in this situation?
Well, I'm really glad you asked that, because it's one of the core messages I want to communicate today is really about, what is affordability and how to define it. And does this rule or that program or anything else influence me? Well, the key word could be influence. It could influence, it could nudge decisions one way or the other. But the bottom line is going to always be in your household, there's this many dollars coming in with some consistency. There are rules about how one qualifies for a mortgage, and they look at your mortgage payment that you're about to take on. They look at your car payment, your line of credit, everything else. They do that math, and you have to be below certain thresholds. The bottom line is, are you, as a consumer, even if you get qualified for it, are you comfortable with the resultant monthly payment? And all the other noise aside, when the room gets quiet and you're thinking yes or no, that's what matters. Whether the number is $1,500 a month, it's $2,500 a month, or $5,500 a month, it has to be something that you're comfortable with. And that regardless of what happens, there's a cushion there to make it right. So that's the thing that I really want to stress to everybody, is the right way to look at it is what can I comfortably afford on an ongoing basis, maybe even having a 6-month buffer in the bank and all those other good pieces of advice we could give people. But that's the core. And all the stuff we're talking about, it's not that it's a long way from meaningless, and it's very important for qualification and lots of other things. But the core bottom line is always going to be, can I afford that payment comfortably?
So how will these new policies help first-time home buyers get into the market?
So on the topic of first-time home buyers, there is a change, and we'll talk about that change first, and we'll talk about the implication of it. So what has now been announced is that first-time home buyers alone as a group, and we'll talk about what a first-time home buyer is by a definition, are now allowed to take a 30-year amortization where someone who's previously owned a home cannot. Everybody else has to use the current existing rules of 25-year amortizations. That's pretty much the maximum. We could talk about circumstances in which 30 is also possible, but that's for another time. Now we're talking about first-time home buyers getting into a mortgage with a new property and being permitted to amortize it over 30 years. Why would somebody do that? And the answer is you have a lower monthly payment. So I just finished giving you the speech about affordability. That's the thing. And if you have a long amortization, it absolutely means you're going to be paying, I'm going to again make up some numbers, but you might pay $2,100 a month on your mortgage instead of $2,500 a month. $400 extra a month of savings or cash that you don't have to spend. It makes it possible for you to buy that. So how can that be a bad thing? Your mortgage payment's going down. Well, like everything else, there's some give and there's some take. It's math. And it's not as if the bank or the seller or somebody else is giving you money. And the bank for sure is really happy because they're making you a deal in which you're committing to pay them for 30 years instead of 25. So to them, that's 2 thumbs up. Why? Because they're getting to charge you interest for longer at whatever the interest rate is. So when you add up the number of dollars that you spend on the sum of your mortgage payments, and you look at, okay, I spent, $900,000 on my house, but I actually wrote checks for pick a number of $1.5 million in the end, that means that I've spent $600,000 in interest. That's a lot of money. I'm making these numbers up, but you get what I'm saying.
Yeah.
And on a 30-year amortization, that row of numbers is just going to keep going longer. And so you're going to be paying more in interest. So again, it falls into the category, just because you can do a thing doesn't mean you should. But here's the crux of it. The new 30-year amortization makes it possible for first-time home buyers, as they're defined, to get a lower monthly payment, be able to afford it, and say, yep, I'm in.
Right. So they're getting into the market. It's easier for them to get in the market.
Right.
Would your advice then be to try and bring down that amortization?
So you've hit that nail right on the head exactly. Because
And how would they do that?
So if your home buyer just signs up for 30 years and just does that, well, here's the list of numbers that says you're going to spend maybe not hundreds, but many tens of thousands of dollars more in interest than your neighbor who took the 25-year. So the right strategy is to say, okay, I'm going to do a 3-year or 5-year mortgage, whatever it is, and it's at that 30 where I'm at the stage in life where that monthly payment is just critically important and it gets me in and I'm in. But then as time goes on, make sure that you're saving those X dollars a month so that at renewal time, you're going to be able to not only renew, but even do a cash payment to bring down the principal and effectively reduce your amortization. And that's the strategy. It's as boring as the one your grandmother used to tell you. Save some money for a rainy day. Get your mortgage debt paid down faster. It's absolutely a good strategy, and it would certainly be my advice to people to spend less than they earn. There you go.
And how about Are there other incentives or programs available to first-time home buyers?
Absolutely, and it's really glad that you're asking that question, because of all the things that a first-time home buyer could do, I generally argue that this increase in amortization is maybe the least interesting. It's new, it's fun, we're talking about it, and it will make the difference for some of your clients, and it's a totally legitimate thing, absolutely. And God bless them if they can find the cash to pay down that mortgage a little faster. The thing that's really helpful is something called a first-time home buyer savings account, FHSA. Ask your bank about what that is and open one tomorrow, maybe today if you have time. A first-time home savings account is very much like an RSP, and it's limited at $8,000 a year. So if you, Scott, and your spouse each have jobs, and it's possible for you to somehow save $8,000 each, and you put it in that account, let's make it up in 2023, and you did it again in 2024, $16,000 each per year. Now you've got $32,000. That's great, and you can use that as a down payment on your house. Fantastic. The simple fact that the money is there to create a down payment is fantastic. But the really great thing is that from a tax time, it gets treated very much like an RSP. It comes right off your income. So if you earned $90,000, magically you're now earning $82,000, right, and you're in that year. And last year you also earned $8,000 less, or you're taxed $98,000 less than you had been. Now, of course, that presumes that you're contributing the maximum of $8,000 a year. It can be anything from zero to there. It grows tax-free in that account, rather like a TFSA, but it's cooler than a TFSA because it comes right off your income tax.
So it's like a combination of an RSP and a TSFA.
You can kind of think of it that way. It grows tax-free, and that's fantastic, but the real benefit is you get that tax savings every year, and it's really real. So for someone who's not yet ready to buy that house, start today, find out what that FHSA is. Don't put it in your TFSA first, put it into this other one first. Then if you have some extra, totally put that in your TFSA. Absolutely.
So this is great advice for first-time home buyers
that maybe aren't quite there yet.
Exactly. Starting to plan for it,
right,
and get prepared. Any other things that they should be looking out for?
And one last comment on the FHSA is that you're buying a house, say in November. Is it too late for me to put that money in for 2024? The answer is no, it's not. So crazy as this might sound, you can put it in on Tuesday, take it out on Wednesday, and it counts. So it has to have been in an FHSA account for an overnight, basically. You were entitled to the tax credit. So even if you didn't know about it before in 2023, and too bad you don't get the tax benefit for that year, you can still get it for 24, I suppose nominally right up to Christmas kind of thing, right? So keep that in mind.
Good advice. Anything else they should be looking out for, first-time home buyers?
So generally speaking, the good advice is really to just make sure that mortgage payment is affordable, that you're comfortable, so it's rather weak advice. It's just make sure that the actual mortgage payment is going to be affordable.
So here's a question about, given the fact that interest rates seem to be on their way down now, what advice are you giving to your clients these days in terms of assessing the different mortgage products available to them, variable versus fixed, and the different terms available?
Very good question. So if I may, I'll answer it by making a juxtaposition between what I would have answered, say, 6 months ago and what I would say now. 6 months ago, it was not so abundantly clear that rates were going to be coming down. It seemed clear that maybe 3 years from that date in the past, they would be lower. So instead of taking the 5, take the 3. There's a modest disadvantage in that you might have notarial costs that will come up more often, sooner than they might have otherwise. But that was probably a good strategy then. And given the available data, there wasn't a better decision to be made then. Now that we've seen a number of interest rate reductions, and there's lots of good fundamental economic reasons to expect that it'll continue to go down. And I could, if you'd like, I have a lot to say about what those fundamental elements are, but we'll get into that. It's reasonable to expect that interest rates will come down, maybe not quite precipitously, but in an important way over the next year and a half. So is variable back on the menu for a lot of customers? The answer is unequivocal yes. So to the question, what would I be recommending to clients? I will certainly be listening first to get the whole story, How long you're employed, how much you're earning, how stable is that? What are your ambitions? Do you have kids? Are you planning to move anytime soon? Is there a chance you might have to change cities? Or there's all kinds of questions that we'll ask. But if everything is kind of normal in the sense that your question presumes, then variable is more likely to be on the menu. And here's the catch: is that today's variable rate, let's pick one, it could be 5.55, is higher than the 3 or 5 year fixed rate of, say, 4.44, 4.54, whatever the number is. It's a whole percentage point higher than the fixed rate you can get today. Well, why on earth would I pay more for the variable rate if I can get this other one right now? And that's a very good question, and you could very well answer it. Heck no, I'm going to get the 3 year fixed, and it's locked in, and I'm good. But if the Bank of Canada lowers its interest rates by more than a point, as is now expected to be the case between now and, say, certainly a year from now, then in just 1 year, yes, you're going to have spent more for a year than you needed to. But in years 2 and 3 and 4 and 5, one presumes you're going to have spent so much less that it'd make sense. So that's a little bit subtle. Now we're talking about paying a little more for a year or however long it takes to get down to that break-even level. And so we have to make up, in order for it to really even break even, we got to have it go lower than our current 3 year market, and for a long time. So now you become an armchair economist.
There you go.
And
what's the prediction now?
And it really means that every single homeowner has to become an expert on mortgage rate forecasting to have a logical decision, right? Which obviously not every one of us is going to be a PhD in economics. So there's not an easy answer to this question, and it's really going to come down, in my mind, the advice I always give to my clients: talk to your spouse and look at the scenarios. What happens if, heaven forbid, there's another pandemic, there's a war, oil goes to 120, all kinds of things can happen, these black swans that they're low probability events. And yet, in life, everywhere, stuff happens, and interest rates are going to do what interest rates do. If I may, I'll take a modest segue and say that just this week, and I'm going to be a little bit of a hypocrite, because sometimes anybody talking about economics is going to be a hypocrite. This week, the U.S. Bureau of Statistics revised numbers that had to do with the period just after the pandemic. And they concluded that, in fact, people had more savings than they thought they did, that they were spending more than they thought they did, that in general, and that the consequence of that is that today the economy is healthier than we thought. And in fact, by lowering interest rates, oh gosh, maybe we're going to be priming the pump a little more fully than we should be. And now, in just a week, there's lots of smart guys going, maybe these things won't fall as quickly as we think. So you're only as smart as the last expert you talk to. And I hope I'll be the last expert that people talk to, because I'm going to say to them, there are good reasons that rates could be expected to go down. Understand that they have to go down more than just this amount. It has to go down lower and has to stay there for a while. It's not guaranteed to happen. What matters is that you are taking this calculated risk and the expectation of saving money. That's a logical thing. But your personal situation is such that you could tolerate variability, increases. And for a lot of people, it's going to be a hard choice. I'm going to say you might save money on the variable, but don't do it. Get the fixed, because in your circumstance, for the mortgage that you got the bigger house, or you got the car payment, or whatever it is, your flexibility is maybe not quite what it needs to be to tolerate a shock, or maybe you don't have the full year of savings and cash that you could pull in. All these things contribute to it.
So it's more peace of mind, sleep at night.
And your spouse sleeping at night is super important too. So
I like the fact that you do this with clients all the time. And I know for a fact, asking lots of questions, finding out about their situation, because like you said, that's the most important thing. I was hoping you could shed some light on what the banks review and consider when looking at applications for new mortgages or renewals, refinancing, because I know each client's financial profile may be different, and how does that affect the interest rate? Because I think that's a misconception a lot of people have out there, that everybody gets the same rate, and that's just not true. They take into account things like credit score, income, employment status. Like Walk me through
things.
that. Walk
Right.
me through how a bank does that.
So this will make every one of your listeners really glad that they're not mortgage brokers, because despite the fact that we think we can be experts in everything, the truth is we can't be experts in everything. We can, and I'd like to say there's nothing to prevent any one homeowner from shopping themselves. You don't need a mortgage broker. You can go to one bank, another bank, another bank. It won't hurt your credit score to make inquiries at all these places within a reasonable amount of time, and you can shop it. But the fact is that there are so many criteria of which you're not aware. It turns out that somebody who does this for a living, who knows what those questions are, and also very importantly knows who has money on sale this week, that turns out to be pretty important. And you might have relationships with Bank A and Bank B and a little bit Bank C, but did you know about these other guys in Toronto that they never advertise, they're not exactly a secret, they're $1 billion company, but they've got money on sale this week for whatever reason. They just went and borrowed something in Switzerland, and and somebody's got a sales quota. They got to move it fast. As crazy as that sounds, just like in running shoes and everything else, so too is it with financial services in general and mortgages in particular. So it very much behooves you to at least consider talking to a good mortgage broker. Probably not 2, certainly not 3. But talk to a mortgage broker and see what they can do for you, because they'll bring you options that are not going to be immediately available. So now to answer your question, what are some of the things that matter? For sure, they're going to look at not only the absolute value of your income, but its stability. The underwriter at the bank is going to be thrilled that you just got a 40% increase, pay increase. That's fantastic. And it'll come to influence the average, but they're going to take 2-year averages of your T4s, for example, because that's a number they think they can count on. Statistics tell them over literally doing hundreds of thousands or millions of mortgages over 50 years. Think about the machine learning that goes into that. What's the profile of the client who doesn't pay? Well, not having consistent earnings is one of the big ones. And if I may, I'll segue just to say that's one of the reasons why the self-employed have traditionally got more problems.
Right.
And why you'd really want, in that case, I encourage our listeners to talk to a mortgage broker. If you're anything other than an employee, talk to a mortgage broker, because there's tons of things that we can do for the self-employed. Because the bank, with its algorithm, is going to pop that in and go, oh, that's,
inconsistent.
Inconsistent is the least we could say. It's inconsistent. And you can say, yeah, but I'm keeping the money in my company and I want to pay the tax. And that's all very valid. But they want to see a T4. And that's how the banking regulators, in turn, look at their numbers, et cetera. So there's consequences. So credit scores, stability of income, absolute earnings, of course. And even when we talk about credit, there's more subtlety than that. It can be about the kinds of things, even the kinds of institutions from whom you borrowed money. Not to name names, but it turns out if you borrow money from a quick check cashing service and you've had an ongoing relationship with them for a long time, somebody's going to go, well, why on earth would somebody pay that kind of I don't like that. Like, if I have 10 clients to choose from, I'm going to choose the 9 that don't do that.
That's a strike against you.
It doesn't help. Yeah. Exactly. So that's definitely an issue. And in a similar way, lots of other criteria will come into it. But in the end, there are a couple of ratios that get applied, and it's, again, just math. And the most important part of what the bank underwriter is going to do, what your mortgage broker is going to do first and help prepare your file, is to look at these 2 ratios that we call a TDS and a in English, ABD and ATD. TDS and GDS. There we go. Sorry for the memory blank. The gross debt ratio and the total debt ratio. Yep. So if you were to ask me, what's a GDS, what's a TDS, and how do they impact my credit, my mortgage worthiness? Well, let's start with a GDS. We're literally going to take that home price with this down payment. You're borrowing this much money at that interest rate for this long. Under these terms and conditions, that's going to get a monthly payment of this much. Okay, so whatever the number is, $2,000, $5,000, whatever it is, we're going to take that, and we're just going to basically make sure that $2,000 a month is not more than 39% of your total pre-tax gross family income. Him and her, whatever the household situation is, we're going to make sure that regularly incoming income is not more than 39%. Pretty simple equation, and it begins to get to that rule of thumb that people use. You shouldn't spend more than a third of your income on rent or mortgage and stuff like that. Well, it turns out it's not 33%, it's 39%, and it's about that simple. Yep. Then there's this TDS, the total debt ratio, and all we're going to do now is take the same say $2,000 a month for your mortgage, but now we're also going to tack on your car payment, your credit card payment, your line of credit, whatever else you've got, those regular monthly recurring numbers. We're going to put those in the numerator, and we're going to make sure that that ratio doesn't get above 44%.
Okay.
So 39 and 44, and that's the fundamental way that the underwriter is going to look at it. And if you have numbers that get in there, you're much more often than not good to go. You're going to be approvable, and whether you do or don't have mortgage insurance, and you do or don't have other things, but those are the key values that people.
And has anything happened with the stress test, or is that still?
So thank you for asking that question, because you recall that I told you that you're taking your purchase price, your down payment amount, there's the amount of money you're borrowing, and I said interest rate. And I neglected to say, because thank you for pointing it out, you might very well get a 444 today from a lender on a whatever, but we're not going to use that interest rate with the resultant $2,000 a month payment. To qualify you, we're going to pretend that your interest rate is not 444, but it's 644. We're going to tack on 2%.
So it's still 2% stress test.
It's 2% stress test. And why? That's not fair. You're right. It's, and by all reason, measures of reason, I'm saying that in order for you to get your mortgage, you've got to demonstrate to me that you can afford a mortgage rate that is a little bit outrageous, 2 whole percent more than what it is today. Except that in the last 5 years, we've seen interest rates go up 4% in 18 months. And admittedly, it's never happened before, and we certainly hope it'll never happen again. But nobody's going to be changing that policy anytime soon, because there's lots and lots of households that have, to some extent, been really saved by it, because they weren't going to get approved for mortgages that they couldn't afford at that stress test higher rate. So thank you for pointing it out. It's super important.
So here's an important one too. You're a mortgage broker, and I'd like you to explain the difference between a mortgage broker and a mortgage specialist who works for a lender or a bank. What's the difference, and how should people approach getting mortgage advice today?
Very good question. And I'm going to approach this one with a little bit more of a consumer hat as opposed to the mortgage broker hat, because I'd like to try to be as unbiased as I can be. Are there competent mortgage specialists that work in banks? And the answer is, of course there are. And there could be people that have been doing that job and doing it very well for 3, 5, 12, 25 years. And they really know their stuff, and they're excellent. It turns out there's not many of those guys. Most of them have been in their job for 6 months. And when they demonstrate that they're good at something, that good for them, they get a pat on the back, they get moved out to do something else. That's the bank's business model, is a little bit up and out and relatively quickly. So while there are absolutely many exceptions to the rule, and there's absolutely many good, very experienced and thoughtful, conscientious bank reps, and we know some, and I'm a coach of my daughter's ringette team, and one of my good friends there is a bank rep, and she really knows what she's talking about. Good. But there's 2, even 3 things that bank reps don't have. The first is they aren't licensed. The education they're getting is from their employer, and their responsibility is to their employer and the shareholders. A mortgage broker, on the other hand, has a fiduciary responsibility. My license issued to me by the government comes with a promise that I'm going to act solely and exclusively in the interest of my clients. And if I behave in any other way, it's nominally grounds for a challenge on my license. So that's a big one. The second one is that the bank rep is able to sell you one product. I want to buy a car. Welcome to the Chevy store. I've got 3 or 5 different Chevys, and they're all great. And they are. They're fantastic. They're really good and great gas mileage. You got an electric one. You got great. Wouldn't it be kind of fun, though, to look at the VWs and the Fords and everything? You might find one you like better. Give them a test drive. That's what your mortgage broker can do, because they can look at lots of other possible lenders.
And some lenders tend to focus on different profiles of clients. Is that true?
That's a very, very important consideration. Absolutely right. So every lender is a business, and they're trying, and just the same way that Nike will market their shoes to go after a certain demographic and make yellow for this group and purple for that group, all those things about marketing apply to mortgages too, unfortunately. And so that's absolutely the case, that lenders will focus and refine their marketing strategy and their product strategy based on exactly that, going after the demographic that is profitable for them. Whereas the bank is really trying to appeal to a very broad demographic indeed. Anybody who has any money at all, you're a potential customer, and that's great. But different lenders, I almost said private lender, I don't mean that. Different lenders will have different policies trying to attract different types of borrowers. And the way that they communicate that, Scott, is fundamentally through the rate. If you can check off these boxes, have I got a deal for you?
Right.
And that's very much what it is. And so whether it's first-time home buyer, whether it's some function of your profession, if you're a medical professional or a dentist or something else, have they got a deal for you? There's lots and lots of things that are related to that can go by geography. They can go by, there are lenders that will specialize in single parents. Knowing that those people have more difficulty getting approved elsewhere, they've tailored a product that is recognizing those challenges.
They've niched down.
They've really niched down, and they make a product that is what they think, and I tend to agree, is really well suited to that.
Yeah, because you just alluded to this earlier, is there's a lot more options out there than most people are aware of. It's not just the big five Canadian banks anymore. There's a lot of lending institutions out there that many people aren't even aware of.
And so while I get to tell you truthfully that I can represent as many as 27 different lenders to a client, I'm being a little bit facetious, not hypocritical, but it's just in practice for any one given borrower, 22 of those 27 are like not on the radar. They do commercial, they do this, they do that. They're not one of the lenders that you'll actually talk to. So it does mean I can talk to any borrower and give them a product that will suit them. You don't want the Chevy with the big HEMA engine and the whatever. You need the Chevette with whatever. And we got that. So it just when somebody says that they've got, lots of lenders, take it with a grain of salt. For any one profile, there's going to be 2, 3, maybe 4 that fit. And out of those, there's going to be 1 or 2 that have money on sale this week. And that's what we're always after, is find with your profile and your ambitions for the future and everything else, what are the lenders that for whom you can qualify, for whom you're attractive, and out of them, who has the best rate this week.
So it comes down to customized, personalized, tailored advice specific to your client's situation.
Right. And I hasten to mention that for most clients, because we've been educated by our parents that it's about rate. And rate is, if anything, probably the number 3 item on my list. The first I'm thinking about is the product. What kind of mortgage is right for you? And it might very well be similar to the one that your neighbor got. That's entirely possible. But only upon hearing the circumstances of your situation, are there children on the way? Are there children today? Are you planning to move? What's your current age? What's your income? All these kinds of questions that will go into it will create a profile that will determine, hey, variable, for example, has the other risks that we talked about. One of the great advantages of variable is that if you had to move for your job, there's a real chance that within 2 or 3 years, I could very well be asked to go to Toronto, to go to Vancouver, to whatever. And boy, the consequence of that could be a multi-tens of $1,000 penalty. If that's, beyond, if it's remotely possible, okay, maybe take it aside. But if there's some kind of reasonable chance, it behooves you to at least weigh that possibility. Look at the variable. Maybe you're going to pay a little more this week, but if you break a variable rate mortgage, it turns out, we can talk about that another time, the penalties are so much lower that maybe that extra you're paying is worth it. It's almost like insurance you're buying for yourself to avoid that trouble. And that's where a seasoned mortgage professional, in honesty, at a bank or from a mortgage broker, that's the kind of advice that you need. If they're not asking those kinds of questions, you're not likely getting the kinds of advice that you really need.
That makes a ton of sense.
Yeah.
Now let's circle back again to the new government policies that we were talking about earlier. Mm-hmm. In your opinion, what impact do you think these changes will have on prices here in Montreal, home prices?
So this is where I take off my professional hat and put on my speculator's hat, and Joe and Scott are chatting over coffee in your kitchen, and I'm going to prognosticate and give you my opinion. And my opinion is, in so many ways, not much. In so many ways, we've kind of kicked the can down the road, but we're solving actually no problem at all. Why do I say that? So at the most fundamental level, one has to understand that home prices are always going to be tied fairly intimately to vacancy rates. And we can look at a North American model and look at vacancy rates in various cities and look at whether they do or they don't have rent controls and all kinds of other things. But when you do that research, you discover that markets in which the vacancy rate is 4.5%, 5%, they're healthy. There's a decent balance in the push and pull between landlord and tenant. The landlord is motivated to spend money to update and buy a property and keep it clean and all those things. the rents are high enough that they are justified sensibly to do that sort of thing. And by the same token, the rates are also affordable. By definition, when the vacancy rate's that high, there's enough availability that the renter has some choice. They're not going to be forced to take the first one they can find. In Montreal, on the island, the number from CMHC for, I think it was the end of 23, so it's not super fresh, but was 1.1%. And for the West Island, it was 0.9%. And in practice, that means that if you get something that even kind of sort of looks like something you can afford and kind of sort of the place you want, you bag it because there's no second alternative to compare. That vacancy rate is so low. So the impact that has on home prices clearly is it's always about that marginal buyer and that marginal seller. Just to change gears a bit, I'll talk about the marginal seller first. The marginal seller is the guy on your street. Something bad happened. Somebody died. Somebody moved. There was a divorce, whatever. And they had to sell this week. And everybody else is selling for 1.2, but they took 950 because they had to. They needed to sell this week. And now Scott, the realtor, or somebody else comes in and does the comparables and goes, oh, well, that's going to take my valuations down a little notch. That one last week went for this, and somebody's going to look at that. So it's that marginal seller that has a disproportionate influence on what's perceived to be the market. In exactly the same way, that marginal buyer who's now a renter, their rent is coming up. They say, I've had enough of paying rent. I want to own a home, everything else. It's that guy who saved up a little bit. The vacancy rate is so tight, but they're that one buyer that saved up just enough to stretch to get that down payment and whatever. And they're the ones that set the price. Yeah. So all this to say that these changes, as they relate to first-time homebuyers now at 30-year amortization, we talked about it before. If I'm not going to spend $2,100 a month instead of $25, I can afford more, and I'm going to tell my realtor, hopefully it's you, but whoever it is, the realtor is going to show me something, we're going to do some math, and I can afford $2,100, and that means that house that's worth a little bit more, that's the one that's got the kitchen, and it's got the swimming pool, and that's the one I want. Cool. And they become the marginal buyer that's going to pay that little bit extra to get that deal done.
So it's going to conceivably create more demand.
So it's not going to have a downward pressure on prices, that's for sure. And remembering it's only that small segment of the buying population, the demographic, that's the first-time home buyer, but they're going to be there lurking with their little bit extra buying power. That price is not going to notch down 50,000. It might go up 25, kind of thing. Yeah. And so there's not so
in that lower price range of the first-time home buyer, we're going to potentially
there's not going to be any, with the vacancy rate the way it is, and with this, then the question really was, what in fact impact is this rate rule change going to have on that market?
Yeah, so making it more affordable may actually increase prices because there's more demand and less supply.
And it's going to, and in a couple of months, it's going to completely dilute the value of this improvement.
Gotcha.
At which point you ask, why did we do that? Because and I guess we could speculate about elections and everything else. But
we need to address supply.
Right.
Is the bottom line.
Sooner or later, you have to address supply. And if I may, I'll just throw it in and say that we can address supply by either getting rid of rent controls, which works in a lot of American cities, but is deeply unpopular in Canada for, frankly, historically good reasons. So that if you're not going to loosen rent controls, then the government's got to step in and provide the supply, government-funded affordable housing, which, by the way, is quite common in Austria and lots of other markets. It's not some radical, crazy idea for governments to get into the housing business. But until you do one or the other, every one of these little tweaks is truly, truly just kicking the can down the road. And this one is going to have the relatively marginal effect of inching up the prices for lower end, sort of sub 750 prices.
Gotcha. Yeah. Are there any other misconceptions that you're seeing out there, things that you're hearing from clients that you'd like to address?
The list of issues is very long indeed. One of them that I would like to address has to do with this idea of, do I pay my mortgage down? If I inherit 50 grand from Aunt Harriet, do I pay my mortgage down or do I invest it? And I'd like to provide what I think, this is a question that comes up pretty often, and I'd like to share my take on it. And if I may, I'm going to digress a little bit and say the following. The numbers prove that if you can be a renter for your whole life and never buy real estate, you can actually end up at the end of the game with more money in your pocket than you would ever have had being a homeowner. It's mathematically possible. And what it means is that the $1,500 a month that you're spending on rent, you have the discipline to say, well, if I was owning a home, I would have been paying $2,600 a month on the mortgage. So I'm going to take the difference every single month, put it into an account, and I'm going to invest it. And if you do that for 30 years, statistically speaking, there's a very good chance you're going to come out ahead and maybe even way ahead. It's just that never, ever, ever happens. You've got your rent payment, you've got your income, and you intend to save that $1,200, $1,500, $1,800 every month. But at the end of the year, you save $2,000. It's nowhere near what you needed to have. So it really comes down to personality types. If you're one of those seemingly rare people that has the discipline to actually take that extra cash, however large or small it may be, but frankly, as your income increases, that amount of money you're saving every month goes up. And you're actually saving, you're actually investing it, getting a return compounded over decades. Fantastic. It's just that nobody does that. And so home ownership for most human beings ends up being the better way to do it. The term that's used is forced savings, and that I think is an inappropriately narrow definition. But you get the idea that having the discipline of, yes, I'm paying a lot of interest at the beginning of my mortgage, and that kind of does not appeal to me, but you are collecting principal month after month after month. Toward the end of your mortgage, you're paying that mortgage payment is going to pay off huge amounts of principal very quickly.
And there are opportunities to double up payments.
All kinds of things, exactly.
To speed that up.
And here's the important thing, is that statistically, if you look at the net worth of Canadians in 2024 and who's wealthiest, and out of them who are homeowners, the enormous majority of them are homeowners. We could argue that maybe too much of their net worth is tied to their real estate. But even if we take that group out and have people that have free assets and everything else, it's the people that own real estate that in the end will be in a position where they can have something of some value to pass on to their children and their grandchildren and everything else, which seems to be what everybody really wants, is to have that nest egg, have that financial stability, to have that comfort. And so while, as I say, it's a bit of a contradiction. I'm saying on one hand, if you're really smart and super disciplined, you absolutely can never buy real estate, or maybe buy real estate as investments only, and never own a home yourself. And it's a perfectly legitimate thing. I don't want to say to somebody it's illegitimate or that's a dumb idea, because it's not. But you'd have to prove to me that you have the discipline over decades, through all the other things that are going to happen in your life with children and everything else, that you're going to be able to behave that way. And that's I think. So when a young couple, say, typically comes in and they're thinking about making that purchase, a big part of the message I give to them, I'll give them a version of that sort of discussion, but then I'll ask them, what are your real goals? Because if it includes having a family, the backyard and the community and the school and the park and everything else, you'll be surprised. I've done this myself, and you'll be very pleasantly surprised to understand just how important that sense of community, that backyard, that school, that park, how important they are in your life. And being a homeowner is the way to get that.
Awesome. Yeah. Well, this has been a great conversation. Really enjoyed it. Thank you very much.
Thank you very much.
I think it's been very informative. And if you're watching this on YouTube, be sure to subscribe. Hit that subscribe button so you get notified when new episodes hit and are launched. And also be sure to subscribe to the podcast so you can listen while you're driving in your car, working out at the gym. And if you felt somebody in your network would find this valuable and informative, be sure to share that. And you can visit us at BroadyWindsor.com. You can visit Joe at Better-Mortgage.ca.
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 That's right. In Beaconsfield, and I'm a member of the community myself, so if you're coming into our neck of the woods in the West Island, you and I both are people that know the neighborhoods really well and get where people are coming from.
Absolutely. We'll put Joe's contact information in the show notes below, and as always, thank you very much for watching. Thank you, Joe.
Thank you, Scott.